Hey guys, it's Cameron here with Emerson House Buyers. Every week I bring you tools, tactics, strategies, lessons I've learned, things that have helped me build up a sizable rental portfolio in about 2 years. Today I want to talk about return on equity and return on investment. So I used to solely look on return on investment. So if I put $100 in and I make $10 a year back, that's 10%, right? That's return on investment. That's return on investment. If I put $100 in, is probably his best on the board. Let's do this on the board. If I put $100 in and my equity is $50, so let's do this. So ROI, return on investment, and ROE, return on equity. Can you all see that? Hell no, you can't see that. Let's get a different marker. You know what I'm saying? How can you see that? Oh yeah, we can see that. Perfect. So again, use the same analogy we did before. I have $100. I invest $100. $100 investment. That makes me $10 a year. That is 10% return on investment. If I invest $100 and I get, which in real estate, just think about these numbers are a little bit bigger, and I get, let's just say, just for numbers, I invest $100 and I only have $50 in equity, but I only have $50 in equity. So this would be like, let's just say all these closing costs, all sorts of insurance payments, things you have to make. There's a bunch of those costs. Now, I'm just using these as simple figures. We can walk through an example later, but just remember the equity is if you sold everything, what you walk away with. So less commissions, less everything. Let's say you put $100 in, but really you only have $50 of equity, okay? And you make $10 a year. Now what is that? That is now not 10 divided by 100, but 10 divided by 50, which is 20%. Does that make sense? So in this example, I spent 100, making 10%, or making $10 a year, and I got 10% return on investment. In this one, return on equity, I spent $100, but I've got all these fees, I've got things I have to pay, insurance, taxes, I've got all sorts of stuff. Okay, I buy a house, I got to pay a bunch of old liens and stuff on it. So I had to spend $100, but I only got $50 in equity. And I'm making $10 a year. 10 divided by 50 is 20%. Okay, so that's why we have to look at this, because you might say, wow, return on equity, that's great. Look at all that money. But return on investment's not that good. Does that make sense? So you have to use these. I want to show this example because I used to solely look at return on investment. I used to say, how much money, if I'm giving you $10,000, how much money am I going to make? But now I say, for that $10,000, what am I getting out of it on a reoccurring basis? So let's look at a more realistic example here. So I invest $10,000. Oh, we'll say $20,000. I invest $20,000. In both situations here. My return, we're not going to go through all this nonsense. We're just going to make this really, really, really easy. My return is going to be $2,000 a year. That's net return after all the taxes, all the insurance, all the maintenance, repairs, all that stuff has been taken out. My equity though, when I buy, so in this example, let's just say I bought a $100,000 house for $100,000. right? I put 20,000 down, so it would be 100,000 minus 20,000. I'm on a loan, and I'm going to get a loan for 80K. 80,000. Okay. Let's actually put that up top. Oh no, we'll leave it right there. So this is the loan. So in the equity, in this example, I got an $80,000 loan and a $100,000 property. So I have 20,000 in equity. That makes sense? Now, 20,000, 2,000 a year divided by 20,000 is 10% return on investment. Over here, return on equity. I'm going to buy a $100,000 house, or excuse me, let's just say 100 and, trying to think for even figures here. Let's just say $120,000 house, and I put 20,000 down. So I have 100K loan. My equity, so I bought a $100,000 house, a $120,000 house for 100,000. That's what I wanted to do. Okay, stay with me here. So I bought a $120,000 house for 100 grand. Now, since I bought, that's my purchase price minus that, I'm still have $80,000 loan on this property. 80,000 or 120,000 minus 80,000 is actually 40,000 in equity. Now, I want to make sure you guys understand that. The value of the home minus the loan for even figures. So value, I said it was worth 120. I paid 100 for it, but I have a loan for 80,000. So that equals 40K. So that 40,000, I'm making $2,000 a year on it. Can somebody tell me what that is? It's 5%. So when you look at this deal, if this was a deal that came across your desk and you're going to go, am I going to invest in that? Return on investment, okay, man, I'm going to make 10% a year. Fantastic. But if that house is worth 120,000, I have 40,000 in equity sitting in there. 40,000. I'm only going to make 5% on my equity. Why the hell would I do that? The market returns between 10 and 12% a year. Why the hell would I ever put my money in here and do it at 5%? I've already discussed in numerous videos the huge difference between a 5% compounded return and a 10%. This is why we want to leverage properties. So let me show you another example here. One more and I'll be done. So let's just say home value is 100,000. 100K. Now this should illustrate this pretty well. I'm going to get a loan on this property for 80,000. On this property, I'm paying cash, so there's no loan, nothing. Okay. Equity is 20K. Again, this is ignoring closing costs, reorder fees, all that stuff. We're just doing it for simplicity's sake. This one's 100. I got 100,000 equity. Equity minus my loan amount was that. My return is going to be, we'll just say again, we'll say this one is 10,000, or we'll say this one is 7,000. No, we'll say this one's 5,000 a year return, and we'll say this one's 10,000 a year, 10K a year. Okay, because there's no loan, so we're not going to have to make those payments. So my my ROI is going to be, or my ROE, excuse me, is going to be 5,000 over my return over my equity, which is 25%. That's pretty friggin' awesome. Over here, 10,000 divided by that is 10%. So this is another great example. And now ROI on this property, return on investment, I getting $5,000 a year. I put down 25. So my return on investment is also 25%. Okay, you guys see that? Because I'm getting 5,000 and I invested 20,000. Okay. My ROI over here, I had to put 100,000 down to get 10,000. So it's going to be 10K or 10%. Now, I know they look the same right now, but they're not the same all the time. This could be totally and utterly different, right? But your return on your equity, basically right here, is what you want to see. So what do you guys notice? You have a lot of money that's making an average return or below average return. If you're going to make, this is totally my opinion. Can you guys see that all down there? 25, 10, 10. Okay. If you guys are going to make an investment in real estate and deal with the time and the tenants and the hassles of things, why would you want to make an average return? Somebody tell me that. Why you would ever want to make an average return? You want above average returns. And if you need above average return, you're going to have to use leverage. You're going to have to take out a loan. I used to want to pay all my properties off and have all my investments that way, but honestly, you just can't do it because you're going to settle for mediocre returns. Now, 10% is not bad. I would probably take that. You're still going to have depreciation, some other asset, some other advantages, and we're not going to discuss here. But if this was 5% like the last example, and you use leverage, you can bump that up to 25%. Now, who wouldn't want to get 25% on their money? I do. I'd love that. So I hope that makes sense. If it does, let me know. If it doesn't, let me know. Okay? That is the best way I can explain the difference between return on investment and return on equity. Guys, I used to strictly look at return on investment because that's what money you're putting in. Now I look at the return on investment for the buy, but my return on my equity when I keep the property. Every year, you're going to pay down that note, meaning you took a loan out for $80,000. You're making payments on that mortgage every month. So at the end of 12 months, that loan is no longer going to be $80,000. It might be $78,000. So your equity keeps growing every year. And if your rents aren't growing every year and your equity is growing, that means your return on equity is getting smaller and smaller and smaller. It might start out at 10%, like this example, but in 5 years, if home prices appreciate like crazy, all of a sudden, boom, like Houston or Dallas or LA, your home value went up 25%, but you're still making this same amount of money, your return on equity might be nothing, which means you need to redeploy the capital. That is my view on return on investment and return on equity now. Return on investment for when you buy, return on equity when you keep it, what you do with it every year. You want to make sure that both numbers are solid. I look for a 15% return on equity and a 15% cash on cash or ROI. I look for 15 on both sides. So I want to make sure that my initial investment is getting me 15%, and then I want to make sure that I'm at least getting 15%. I have everything from 10% or 8 or 9% to 80% return on equity. What that tells you when you look at that return on equity that's below your target, 15%. I need to raise rents. I might need to borrow more money against that project, take some of that equity out and redeploy it, or sell it, get rid of it. Take that cash and redeploy it in another property. That's how I look at ROI and ROE, or return on equity and return on investment now. If that's helpful, let me know. If it wasn't, let me know. I can do more of these. If those examples were not good and you guys couldn't get them, let me know, and I'll redo them. We'll do another one. I want to make sure you understand this, because I had to sit down with an investor and I thought, no, this guy is full of crap. This doesn't make any sense. And why would you ever look at that? No. It's return on investment, because that's the money you have in it. But it's not the case, guys. Got to look at return on equity. I mean, it's like a pile of cash sitting in that house. You want it to work as hard as possible. You don't want to get 4, 5, 6% on your money. You want to get 8, 9, 10, 15, 20, 30, 40, 50% on your money. That's when people get rich. If you can do that for years and years, that's how you get rich. Okay, cool. Thanks, guys. Appreciate it. See you next week.